All right, welcome back, traders. John Caruso here. Another edition of Futures Forecast. It is Tuesday, January 31st. We're recording Tuesday evening for February 1st. And of course, tomorrow is the much anticipated February FOMC meeting. We do, as we move into the back half of the week, this is the belly of the beast in terms of the data. We've got a very busy week. We've got the Fed tomorrow. Then, of course, we've got mega cap tech earnings on Thursday. We do have also the ECB on Thursday as well. So that's going to move around the currency markets. And of course, if that wasn't enough for you, we do have the January non-farm payrolls number on Friday. So we're just going to kind of put the Fed in the under the microscope here a little bit here in terms of what the market's expectations are for tomorrow's meeting. Largely, we're expecting 25 basis points. We've heard some whispers of potentially 50 basis points. I think that's largely going to be incorrect. So 25 basis points, that's the base case. We do expect to hear from a very hawkish Powell. I don't think Powell can risk even a hint of dovishness tomorrow because clearly with the S&P 500 and the NASDAQ off to a fast start for the year, they're clearly trying to discount Fed hawkishness going forward from here. They're trying to price in the idea that all the hawkishness has been left behind in 2022 and that the Fed is only going to get incrementally more dovish as the year drags on. So clearly the market's pricing in economic nirvana right now, slowing inflation. They're trying to price out the Fed, that they're going to be out of the way by early summer, and potentially the idea that they might even cut by the end of 2023, which I largely disagree with. I do not believe we will see an interest rate cut unless we do see economic conditions deteriorate much faster at a faster pace from here. So, which is certainly a possibility and a probability we think going forward. Also, the market's also discounting the idea that corporate profits and earnings are going to slow in Q1 and Q2 like we're expecting. So clearly, we do think that the market is this 11% rally in the NASDAQ, this 6.5% rally year to date in the S&P 500. We do think the bulls will largely get caught off sides at some point. We do think the period of risk that we're coming into is going to be February to April, somewhere in that area. So we are moving into that risk area that we think it's plenty of risk lies ahead for this market. We're still staring at a very inverted yield curve. There's a lot of stress on the curve, minus 70 basis points in the 2 and the 10 spread. Got contracting PMIs. We've got contracting M2 money supply data and slowing growth from here. We actually do have Q1 GDP tracking right now at minus 2.4%. I think the Atlanta Fed is roughly right around positive 0.7%. So somewhere we're going to be in the middle, we believe, and we're going to be staring at a deeply red number with the release of the Q1 GDP numbers in April. How fast and how soon it takes the market to figure that out? Well, we're going to be data dependent from here, clearly. So that is a look at the Fed. The market's largely trying to discount the Fed going forward. So that's the other thing is that, perhaps Powell has to shock this market tomorrow. And one way he could shock the market would be to potentially tack on another 25 basis point interest rate hike out in May, which would raise the probability on the CME Fed Watch tool. And the Fed, it tries to guide the market to a path of 5.25%. Right now, the market's expecting 5%. There's been a lot of hesitation as to whether or not there's many out there that don't believe the Fed can get to 5%. But at this point, you got to believe that they're going to get to 5%, and perhaps Powell shocks the market and moves the goalpost once again to 5.25% on the Fed funds rate. So we're going to be glued to the screens tomorrow at 1 o'clock with the release of the statement. Then, of course, 1:30 is the press conference. I'm also looking forward to hearing more about the quantitative tightening and the Fed reducing the balance sheet. So in effect, what's going on, there's double tightening. The Fed is still raising interest rates, head on into a growth and inflation slowdown, and they're also running the balance sheet off. So even when they pause on hiking the Fed funds rate, they're going to be running the balance sheet off in the background. We've never seen that happen, quantitative tightening. So it's going to be interesting to see how it plays out from here. So let's get over to the chart here. March basis, S&P 500. Clearly, we're still steering at a bearish trend. Clearly, this big fat red line that we've got drawn on here, that's the downtrend line that the market's largely been respecting for the better part of the year. And we are punching through that. We did see a punch through there in the beginning part of this year. And currently, we're trading 40.81 on Tuesday evening. So I'm going to flip over to the daily chart, maybe zoom in for you guys so you can see it a little bit better in terms of what I'm looking at. And clearly, we've had this upward bias in the market since the start of the year. That takes the S&P to up 6.5% year to date. This shaded gray box in here, we do believe is going to be an area of resistance where the market starts to kick back and starts to show some signs of rejection in here. I don't have an overbought reading quite yet. I'm only tracking at 65 on my oscillator down here. So potentially we do punch higher, punch into this 4,100, maybe as high as 4,150 again before we start seeing some rejections on the chart. But we do think that a big period of risk lies right here between February 1st and about mid-April of 2023. And you can clearly see that's how we have it drawn in on the charts here. So perhaps we punch a little bit higher, start showing some signs of rejection. We get a peak and roll down, retest the top side of this trend line at 3,900. And perhaps we get another bounce in here and then another failure out here deeper out into the spring. We do have a chance potentially retracing all the way back to the 38.2. That is another retest of this consolidation zone. Whether or not this is enough to hold the market and prop it up and move it back higher is really anyone's guess from here. We do think there's a probability moving into the springtime that you could start to see some credit events in some of these markets. Clearly, financial conditions are as tight as they've been in a very long time. And we do think that the corporate profits and earnings cycle is slowing in Q1 and Q2 from here. So as you can see, I also have the 100% retracement drawn in here on the chart. That's right around 4,300. If the market were to somehow be able to power through here up to 4,300, we would declare from a technical standpoint that the bear market is over from a technical standpoint. So see that as a very low probability of achieving that level anytime in the near future. The highest probability is we're going to start experiencing some rejection. We're going to say between right here about 40.85 and 41.50 on the upside in the S&P 500. So that's a look at our expectations of the S&P 500 going forward. Clearly, you can see a period of risk that we have drawn in going into the springtime. So start thinking accordingly, maybe some option strategies to perhaps try to capture some of that increase in volatility going into the spring. And we'll see how it plays out. I had a great time joining you guys this evening. If you are joining us from Paradigm Futures, welcome aboard. There's going to be more of these to come. If you have any questions, feel free to reach out to me directly at jcaruso@rgofutures.com or jamie@paradigmfutures.net. And we're going to be posting our market memo that we put out to our traders every single morning on their website. So you guys are going to have a chance to sample some of those ideas that we put out every morning to our traders. So best of luck to everybody out there. Catch you back here next time. Take care.